Hey yo, what is up, dudes and dudettes? This is Diligence here, and today we're going to talk about the part 2 of MMTLP. So this one is a little bit intermediate for those of you who don't have very long attention span. Well, actually, I'm just going to make it as short as possible. I'm gonna explain some of the business lingo that's very important in here to understand what really is going on, especially the preferred stock component. Because I spend hours on Patreon trying to answer people's questions. So I think, answering the questions, I think those questions probably will apply to you guys too. So I'll probably answer it on YouTube. So then a lot of people not gonna repeat the same question over and over again on Discord chat too. So here it is. So in part 1, we covered, MMTLP is basically something you hold to remain your right to the torch asset sell dividends, right? We talk about when you still hold it, when you still have it. That means one share of MMTLP will ensure you one share of the pie of how much, Torchlight eventually sold their asset. And let's just say they sold it for, 300 million. And then we have so many outstanding, we have X amount of outstanding share of MMTLP. And then you divide, the number of how much they sell with the, by the number of shares that's outstanding, and everybody gets, X amount of dividend, right? That's the whole dividend payout sort of thing, right? And we clarified that MMTLP is traded on the OTC market, which implies that there's going to be higher risk and less regulation. And the fact that it is higher risk and less regulation, it's probably not going to be as attractive as, say, a preferred stock traded on the NASDAQ, which then we get into the preferred stock regulation or preferred stock sort of requirement to be listed on NASDAQ. And sort of that will give you a expectation on why that they decided to do it on OTC, and then sort of like the value or price tag cap means top, right? The price roof of MMTLP is gonna be okay, and MMTLP is not unrestricted, which will face some liquidity problems later on. So for those of you who are trading on the OTC, you know that because it's a sort of like a derivative-like product, which I will explain later why it's called a derivative-like product. It's not really a true derivative, even though it's a preferred share sort of security. And the fact that it's unrestricted, which just means, some can trade, some cannot trade, some can sell, some can buy. Not everybody can buy and sell. Not everybody can sell at the same time, blah, 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 blah. Which make it, when you trade it on OTC, say on TD Ameritrade or on, Fidelity, you pay a portion of the trading revenue or the whatever profit. I'm assuming that you guys are making profit. If you're not making profit, what's the whole point of flipping this shit, right? Then, you pay a portion of it as commission because the OTC market is way more complex, and most, OTC market securities still charge you commission, especially you're on Fidelity. And, you can only place limited orders. So for those of you who are trying to place market orders for this, it won't work. So if you want to buy and sell this on TD Ameritrade or Fidelity, you have to place limited orders, because the whole market making process is very complex when you're dealing with OTC, especially with a security with limited liquidity like MMTLP. You're basically trading at the mercy of how many buyers are there on the market and how many sellers are on the market. Once my buyers overweight the seller, you will see a short squeeze like what happened on, is it Monday or one of those days that we're allowed to trade on Robinhood, right? And then when you see a overwhelming majority of sellers and no buyers, then you will see it go back to zero again. But anyways, okay. A fourth point we covered last time was MMTLP is a preferred security. So today we're gonna dig into why preferred security is kind of iffy and dangerous in this situation. Okay, so first of all, you have to understand this thing called liquidation preferences. So let me explain to you what liquidation preferences is. Without making it too complex or without making it complicated, let's just say you have a company, right? Just say DD have a company. Me and them two created DD1, which is a company. And then we own some debt. We issue some preferred security. And we issue some common stock, all those kind of stuff. And one day, all of a sudden, financial crisis hit, or let's just say DD got assassinated. And apparently the assassin got all my password, and then he got into our company and steal all of the asset, and essentially we went bankrupt. And when we went bankrupt, we gotta pay out our debt, right? Like for example, we have like asset to sell, like just say Didi and number two bought a castle, and then our business is essentially trading diamond on the black market, and then we still have just say diamonds in the inventory as our asset. So what we're gonna do, or what number two is gonna do, he's gonna mourn that I died, but at the same time, number two gonna sell all of these diamonds and distribute all of these liquidated assets to our shareholders. So this is when liquidation preferences come to play. When a company go bankrupt, the debt owners, so basically if you owe debt, basically you own bonds of the company, those people get paid first, and then preferred stockholders, and then common stockholders. So if you're common stockholders, you get paid the last, okay? And then what is interesting is debt usually is issued by interest, right? Like for example, if I lend Charles $1,000 and probably gonna, because we're friends, I probably just get him like, 2% interest or whatever for the yearly, right? But he probably can get a better deal in the, in a bank. But because, probably if he asked me, I would just give him right away. So then he probably just gonna ask me. And then for the, the purposes of convenience, this is why he's trying to take a loan from me instead of the bank, right? And, it's dealing with percentages. And common stock is not dealing with percentages, it's dealing with equity. Like, how much money you make in total in this company, and then you sort of divide that by how many shares you have owned in the common stock, and you will get like, earning per share, right? Like it basically means like how much you make per share. But preferred stock is like a hybrid, which means technically speaking, you can make it in a way where it take a percentage, but also take a percentage of your profit. For those of you who work in the VC, or just like us who actively work with VCs, or have a startup, we know that preferred stocks are literally a customized stock. What does it mean by customized stock? So this is how it goes. If you issue common stock, you have to follow state laws. Okay, state or federal laws. For example, if the federal law says that you cannot issue a stock that have a par value less than an X amount, you cannot. Or you cannot issue a stock that, does not have a real-time quality, but have, say, a common stock that basically is callable in 5 years. You can't do that. You cannot do that. It has to be every common stock are comparable with each other. That means the way how Apple prices their common stock is the same as how MetaMaterial created or priced their common stock. Okay, this you have to draw into your mind. Why? Because preferred stock is different. Whoever issued the preferred stock can make the terms in the agreement whatever they want as a company. So then you guys are like, oh my god, then what if it's a scam, right? Exactly, what if it's a scam? But the problem is, in order to issue a preferred stock, you have to get board approval. We are assuming that the board of directors actually act, because they have the legal obligation to act on behalf of the company and think on behalf of the company. So they want to make the best business decision ever. So then they will issue preferred stocks, which is... And then there's also a legal gray area here, because board of directors technically is responsible for all of the shareholders, but in terms of the priority on their list, their primary job is actually to make sure that the business runs as smoothly as possible and make as much money as possible. Therefore, sometimes there's a conflict of interest in between how the business are run and how the shareholders actually will get money from the business. You guys are like, how? Here's the reason. You have your old shareholders and you have your new shareholders. Your responsibility is to your old shareholders, because by the time you're making this business decision, you're only making them for your existing shareholders. So does it mean that you have to respect your future shareholders? Sure, why not? But it does not necessarily mean that you cannot create another class of financial instrument that might or might not con your future shareholders a little bit. This is why a lot of times when preferred shares are traded on the open market, you will see a very similar pattern like this. Usually on the first day of trading, people are just getting their feet wet. Let's just say first day of trading, they trade it from like $1 level. And usually we have data to support this, right? So on the first day, it's gonna go flat a little bit like this, and then all of a sudden, like on the second day, let's just say on a day 2, a lot of people like suddenly realize that there is liquidity freeing up in the market, and a lot of people might buy this stock because, let's just be honest, a common stock, because you know how they were priced, because you can compare one common stock to another common stock, right? Then you can figure out, okay, so if this company goes to IPO, the IPO price is $30, and then based on like how much they're worth, technically it's probably gonna trade up to $42, and bam, market opens $30 all the way, like 20 minutes later it becomes $42. You're like, oh, it's at fair value, and then I can just trade it as usual. But for preferred stock, it's different. You can only know how much a preferred stock is worth after the first person traded it. So the first person who traded the preferred stock on day one determines the precedent of how much this preferred stock is going to be traded. And they also determine the spread of the preferred stock. And usually the spread of the preferred stock is wider than common stocks. That means there's going to be a huge price discrepancy, which means it will have a huge implied volatility in the trading place. So what happens usually is, on the first day, it will go like this. On the first day, it's like, oh my god, it's going to trade flat a little bit. And then on the second day, it's going to trade flat a little bit. And then on the third day, on the fourth day, when a lot of people realize this is open up, because a lot of times we don't get information like, what preferred stock is now tradable. And, sometimes they may gain a listing on the NASDAQ or OTC, but nobody trades it. So then they can, like, the market makers themselves have to sort of make a rational decision on how much the security is worth. How would they know that? They either get data from the market, or they can just look at the data on real time, like selling or buying it, right? Because they have to hedge their positions because they're the market maker. If you guys want a video on how market maker actually works, I'll probably post that next week or something. There are too many videos to make right now. I have too much ticker requests, and I know you guys are sort of like very pumped up about like this inflation higher than expectation, and you guys are really worried what's gonna happen. So I'm gonna make a video addressing that. But anyways, going back to this thing. So on day 3, when there are a lot of buyers coming in, you usually see a short squeeze on the preferred stock, right? But then the problem is on day 4 and day 5, when people start calculating how much this will worth, especially the time value of this, usually we will see a dumping down. So usually a preferred stock trading is similar to a meme stock pump and dump. So you will see a temporary go up like 100% or 200% of a base price. And then it will dry down, trade flat a little bit, dry down a little bit. And then when more and more platform opens up trading, so let's do it this way. It will go up like this and then go down and then trade flat. And go up a little bit, go down a little bit, and then when more and more trading platform open up the trading opportunity, say they allow buyers and they don't allow sellers. Well, actually, if you allow the same amount of buyers and same amount of sellers into the market, it will just trade like this, right? But usually, what will happen is there are going to be more buyers than sellers if they open up on all major platforms like Weibo or whatever. And then what's going to happen is it's going to go up. But it won't reach the top of the previous high because you can't get twice that amount of people to buy this. And then eventually it's going to die down to its true value. Usually this is what's going to happen on a preferred stock. You can go on the OTC menu to look at this. And I do think MMTLP is an outlier because you have way more people want to buy into this because George got more cloud after the merger than before the merger. If you follow his Twitter, we actually did a very detailed data analysis on that. So a lot of people actually want this. This is one of the reasons I didn't sell off the day that I can, right? Because right now Robinhood, like you cannot trade this anymore. So I'm actually really lucky that I already liquidated at least half of my Divi shares or MMTLP. But one day it will probably open up again and then probably seize the day and see how that goes. Because I do think this is what I tell my Patreon members. On day 1 I only see it to go up to $3.2. I don't see it to be over $3.5 at all. And if we open up more platform opening up this up, and then we probably will trade close to $3.5 to $3.8 because whenever it reaches $4, the market cap actually exceeding the total asset worth beforehand, or even exceed the total asset worth of MetaMaterial itself, it doesn't really make sense, okay? So this is what I think. This is why I didn't sell all of it, because I actually think people is going to hold more, and then by the time they FOMO, I probably just set a limited order and then sell just like maybe 2% below the highest point, because we can forecast and we can use data to forecast how much it will worth depending on how much volume actually just pumped in a short period of time. But anyways, this is it for this video, and next video we're gonna dive into the probabilities and dive into the scenarios why they're doing this, and dive into perhaps we can guess where those shares are issued from. And tomorrow in the MMAT international conference, we actually registered using our business to register that. So then in that conference, I will try to ask a question about this. I doubt George's gonna say anything about it, or we're probably just gonna get kicked out. But I really want to know which company those preferred shares are issued under. Anyways, this is it for this video. Hope you guys love it. These are all factual contents and business education. If you want more people to learn about this, know about this, share our video, share my video with your friends, share our videos with the people you think is important and who are investing in stocks. And if you like those kind of content, smash a like button and subscribe. See you guys on the upside.